Welcome to the SDA Housing Podcast, brought to you by Ndis Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello everybody, my name is Min and I'm your host from Ndis Property Australia, and you're listening to the SDA Housing Podcast, a show that explains, highlights, guides and brings awareness about all things SDA in this ever-changing world. Today we have a special guest speaker, Mr. Paul Grant from Access Lending. Paul, how are you?
Good, thanks, Min. Nice to be here.
Thank you for flying all the way over to Brisbane to be in our office to help us get more understanding and training and exposure to the ins and outs of SDA lending. Paul, who are you? What do you do? What's your company get up to in the background there? Please educate us who Access Lending is, please.
Okay, Min. Yes, interesting question and very confusing for people to understand. Access Lending, Min, is a mortgage management company. What does that mean? We are, if you like, the conduit between a wholesale lender who wants to play in the home loan space but does not have a branch network. We act, if you like, as that network for them. They don't have access to clients. We have access to clients via referrers like yourself, brokers, real estate agents, who come to us to obtain a loan for their client, more often than not, with a specific niche, as is Ndis.
Great. Now, your role in this mortgage management company, please?
So I'm a business development manager, but I also loan write. So I liaise with brokers who want to write loans with Access Lending. So I act as their sales manager, for want of a better word, to help them through the process. I also deal directly with clients who want to get into this space and want someone to write the loan for them who understands how it works. So hence I act, if you like, as their in-house broker and help them through the application process.
Wonderful. Paul, a lot of the times we have to explain to our clients who want to move along the journey of the pre-approval process, the difference between them going to a normal broker, accessing a normal lender like the big four banks, versus a non-bank lender. Can you explain to our listeners why is the non-bank lending sector more active in the SDA lending space as compared to the big four banks, please?
Okay, Min. So at the moment, and this may change in the future, the big four banks don't appear to have an appetite for writing NDIS loans. It's not to say that they won't do a construction loan for a client, but they're not valuing these properties as an SDA property. They're valuing them in comparison to a normal house, and they're also not accepting the commercial rent that these properties may receive once tenanted. They're just taking standard market rent, which means the valuations historically were not coming in on the contract price. And obviously, if they're not accepting the rent the property is going to achieve, it's affecting clients' serviceability when they're trying to borrow money to buy one of these properties. The non-bank space, we have one lender, and there's only one lender in Australia who is doing these deals for what they are, which is a specialist NDIS property. Albeit it looks like a house, but it has a commercial flavour to it, and they're accepting those rental returns that they're likely to achieve, and they're also obtaining commercial valuations to get them valued for what their true purpose is.
So what you're saying is a client can go to a bank, but the challenges are going to be valuation and serviceability, which basically means you'll have to put more of a deposit down, being a 40, 50, 60% deposit to make the deal work, correct?
Correct, I mean, yes. And I've spoken to many brokers to find out from them where would they go to write one of these loans. And the majority of them have said from all their resources, their networks that they use, in far as banks, etc., are not doing these loans.
Gotcha. So moving on, how long has your organisation, Access Lending, been involved in the NDIS lending space?
So we've been writing NDIS loans for probably 4 years now. Personally, I've done over 200 of them myself for clients. So we think we're certainly learning, and we've learned a lot along the journey, but we think we understand how it works, how to make it happen, and what's the process to get the client the result they're looking for.
And those 200 loans you mentioned, that your loans you've written or the company's loans written?
They're loans that I have written on for the company.
And any challenges with those 200 deals in terms of location, postcodes, valuation, serviceability? What lessons have you learned as part of this journey in SDA?
So yes, lots of lessons I've learned. Only having one lender that plays in this space, you're only able to do what they are prepared to do. So, for example, they have postcode restrictions. Capital cities are fine. Major regional towns are fine. If you're starting to go to some of the smaller towns with small populations, they will put restrictions on that. And what they mean by restrictions, you'll need to put in larger deposits. Other points of contention you'll find, the valuations. The valuations, they're commercial valuations. They are taking 2 to 3 weeks to turn around. So if your client's got a purchase contract with a 21, 28-day finance clause on it, they've got to bear in mind that it's going to possibly be a struggle to meet that time frame and extensions may be required. You're also dealing with the lender's credit policy, and it is very much black and white. They have to obtain certain pieces of information for them to be able to approve your loan. If they don't receive those details, they will ask you for more information. It is not unusual for them to take, with including the valuation, 6 to 8 weeks to finalise, approve, and have this client's loan processed ready for settlement.
Gotcha. Question, moving on, valuations. The valuations has been a sticking point for the last few years. We've seen, I remember 4 years ago, we were seeing 100 to 200 grand shortfall valuations as the norm back then. And I guess over the years, being the last year to 2 years, we're seeing more of a closer towards contract pricing, and that's being more appreciated nowadays from investors than before. Why has this become better, or why have these conditions changed over the years?
Yes, definitely those sort of variances you talked about, we were seeing them as well. And historically, valuers and builders tend to disagree on price. As time's gone on and everyone becomes more educated, the valuers are valuing these as a commercial property. The commercial rent return that they're going to receive once occupied is a factor that they take into consideration in the valuation. So they're not valuing it against the standard house around the corner. They're valuing it based upon the income it is likely to receive, which has certainly meant the contracts are coming in on contract price fairly well every time now.
And so our listeners can understand the process when you start this journey for NDIS lending, pre-approval, loan application lodgement, formal approval, valuation delays. That whole process could be quite long, couldn't it, Paul?
Yes, 6 to 8 weeks. And initially, your client will come to me and I will do a borrowing capacity for them, issue them a pre-approval to let them know how much they can spend on an NDIS property. I take into consideration the type of property they're going to buy, because then it tells me the type or the amount of rent that it's likely to receive once occupied. With that pre-approval, it then depends on whether they are what we call ready to buy or not ready to buy. So both clients will receive an approval. The ready to buy client is somebody who has got cash in the bank or has completed an equity release already to be able to supply deposit and costs. The not ready to buy client still needs to do that. They've got to do their equity release, or they've got another property that they need to sell. So they've got capacity, but they're just not ready yet as far as having deposit funds available.
So would it be fair to assume that the ready to buy client, the not ready to buy client, being the equity release, valuation, serviceability from the original bank, is a 3 to 5 week process, plus the 6 to 8 week process you mentioned earlier. So that makes it a 10 to 12 week process all up?
It can be, if they're going back to their own bank for an equity release, which we always give them that opportunity to do so, that's where their relationship is, that is going to take them a month. The NDIS property process won't start until we have evidence that their equity release is in place. Look, alternatively, our lender does do normal home loans. If your client wants me to and that the product is a good offering for them, I can process their equity release for them and do the NDIS at the same time because we're in control of the one transaction. So, we can cut that down from 4 weeks plus another 6 down to that standard 6 to 8 by doing both deals at the one time.
Gotcha. Now, this time frame is important. I'm bringing it now because normally contracts to purchase in real estate are 21 days finance plus 2-3 weeks settlement. So if 21 days to do finance as per the contract is in there, and you're talking 8 to 12 weeks here, that's going to be a bit of a challenge trying to juggle the expectations of the selling vendor with the finance and the buyer's side, isn't it? It's a bit of a challenge.
It is, yes. And every time I see a contract come in with a 21 or 21-day finance clause, I know straight away you just can't meet those time frames. It requires the client and or their referrer partner that they're using to obviously have a good relationship with the vendor's agent. And it's more about the process. If that agent is aware that your application is moving, a valuation is being done, it's in with the credit team for approval, more times, 9 times out of 10, the vendor's happy to extend. They know the deal's almost there. It's just going through its process. No one's sitting on their bottoms doing nothing. It's actually moving forward. It's just taking time.
But extension requests is going to be a constant thorn in the process.
Yes, and probably 2 or 3 of them is going to be required because normally when you extend for 7 days at a time. In a perfect world, I mean, I'd love 60 days on contracts, but that's not going to happen. But we've been appeased the vendors that the deal is moving and it's a week or it's a 2 week away. Some things are outside of our control. The client might need to give us something. And to take Christmas, for example, they've gone overseas and they've got no access to email. Sometimes things can't be provided in a fast manner, but we do our best. And obviously, if everyone's on the same page, in communication, knows what's going on, it's certainly not unreasonable for extensions to be granted.
So if extensions were to be granted, cool, no worries. My concern or a concern from an investor would be, well, at what point will extra valuation costs be incurred due to the extension request because of the equity release is slow, or the valuation process is slow, or the paperwork compliance is slow? At what point do you see a second set of valuation costs, being $3.5 to do the valuation, being imposed on the borrower as a second val cost?
Yes, Ming. So $3,500 is what it costs. These are commercial valuations. They are more expensive than a normal house valuation. Approvals and valuations are valid for 4 months. Now, normally the valuation is done a few weeks before you obtain your approval. So it's not till after the approval. So it's more pertinent when we're waiting on land to register. So if approval's been given, a valuation's been given, but settlement is delayed because of land registration issues, if that goes beyond 4 months from the date of the approval and valuation, the lender does ask for all the documents to be updated for the approval and a second valuation to be ordered, hence a second lot, $3,500 to the client.
Look, and I bring this up because we've seen from experience the last few years, registration of land is always pushed out due to councils, right? So that's just a common factor in the market. So if there were a delay by 1-2 months from the council for registration, and that pushes your 4-month expiry over the line, then you're going to incur additional valuation costs. And that's no fault of our own or the valuer's own, or it's just a lending policy. So please be aware of that, listeners. But more so the point, the average cost, Paul, you say $3.5 for the valuation cost, but what is the total, in the perfect world, what is the total cost for finance, valuation, application to the lender to get an approval?
So yes, I mean, to finance an Ndis loan, you will have a $3,465, or it's $3,500 valuation fee. $394 is the application charge. $395 is what they charge for, called an annual facility fee. You will pay legal fees. Legal fees will vary depending on whether you are a mum and dad purchaser or you are a company trust purchaser. If you were to allow between $500 to $1,500, depending on that structure, that's what you'd be up for. You have progress inspections. So the build contracts normally have 5 progress payments. We tend to send the valuer out there 2 to 3 times to check on the work. They charge, let's call it $500 each time. Twice there's $1,000, 3 times there's $1,500. The last one that you need to pay, and you can't avoid it unfortunately, with a 10% deposit, they have a risk fee, or call it mortgage insurance, so the listeners might understand mortgage insurance a bit better. That's 3.5% of the loan amount. with a 20% deposit, it is 1.5% of the loan amount. 30% deposit is 1% of the loan amount. And you probably wouldn't want to put in a deposit any larger than that. So unfortunately, the risk fee is unavoidable. These costs are all paid at settlement, bar the valuation fee, which is paid upfront. That is the total cost to borrow.
So we're talking about 6.5 to 7 grand.
At an 80% lend, yes. Obviously, it's more expensive at 90% because that risk fee is higher. So you might be looking at 20, 25,000 at 90%.
So for now, in the perfect world, we're looking at 6.5 to 7 grand. Cool. Now, you mentioned the word 10% deposit, 90% LVR. What's the ratio of loans you're doing for NDIS investors for SDA properties being 10-90 and at 20-80 ratio?
Oh, look, man, it's probably 50-50 in all honesty. And look, quite a few of the ones we do at 90%, they could put in a larger deposit. They choose not to because they want to leave money in the bank to be able to do another one later, or they just want to leave money in the bank for a rainy day. They've got other needs. They've got other mortgages, living expenses. They just like to put in minimum deposit for those reasons.
So let me do some rough numbers here. For $1 million purchase, 10% deposit is 100 grand, 90% LVR is 900 grand loan with a 3.5% risk fee LMI. So 3.5% on 900 grand is about 30 grand.
Well, you're probably looking at total costs about 150. That's deposit and fees, and nearly 200K on an 80% deal.
Cool. So 150 versus 200 grand. So it seemed like you might as well go the 20% lend then. Sure, it was that close, yeah?
Depends on how you want to sleep at night and how much cash reserves you want to keep. These facilities do come with offsets, so you can always put additional funds into it if you want to.
Gotcha. So you mentioned earlier in our offline, in our meeting this morning, you said that probably half of your inquiries coming your way as an office, there's ready to buy, not ready to buy, being 50-50, so 50% not ready to buy due to equity release and everything. Is there anything else they need to prepare for getting things ready prior to coming to you?
Okay. Yes.
So here's the two questions. What do they need to get ready first before coming to you? And then what do they start getting prepared after you've spoken to them?
Okay. So yes, I do the borrowing capacity, which is almost a quasi-loan application. I'm not a credit major. I have been in the past, so I do understand what the lender's going to ask for. So I do need to confirm income. So I will ask for pay slips, and if you're self-employed, I will ask for financials. I do need to see bank statements to show income going into those statements. It shows living expenses. It shows loan repayments. They want to see your loan statements as well to see your conduct. They'll want to see your identification as well. And a lot of clients get confused or misunderstand, why do you need to see all this detail when these properties, once they're tenanted, they service themselves? Well, we've got to take into effect during construction, there's no rent coming in, so you're obviously servicing those loans during construction. And it may happen, I'm sure it does happen, once it's built, there's no tenant moving in on the first day. So you will be paying the mortgage payments until some tenants move in. So that's why they go thoroughly through your income and statements and loan repayment history to confirm your ability to service these loans in the event they are vacant.
Gotcha. Thank you for that. When we refer clients to you, when referral partners refer a business to you, Paul, is there an expectation that they should be aware of the process and how different this is, or you take them on that journey in the initial phone call when you do talk to them?
Definitely, Min, because it is a long, slow process, and in the past I have had clients that frustrated about the amount of time it takes because they recently bought their owner-occupier house and it took 3 weeks, and that's fine. It's different lender, different set of policies, and it's a different product. This one is very specific in what it requires, and it does take that amount of time. As I said, 2 weeks for valuation, maybe 3, depends if it's regional, couple of weeks to get the deal assessed by the credit team. They might come back and ask for more information. They'll give you a simple example. They require 90 days bank statements for your savings account. I've had clients give me statements that cover 75 days. Their lender will come back and ask for another 15 days. They want 90 days. So I do ask for clients to give me these details, and more often than not, they do. Occasionally they don't, and it could be just the statement cycle doesn't cover 90 days. So there's things like you have to do an internet printout from a start date to a finish date, which then covers off the difference. But I'll work with them through that process to try to simplify it. But it can be frustrating because it is a long journey and things expire. Payslips are good for 30 days. So if I order the payslips too early and it takes 5 weeks for the valuation and the assessment to start, they're probably going to ask me for another payslip. So I try to educate the clients up front that this is the journey we're going to go through so that they're fully aware that it's time consuming. We've got to do a bit of work, but at the end of the day, we'll get the result we're looking for.
Gotcha. Speaking of serviceability, you mentioned earlier, as you said, when construction begins, there's obviously interest costs of the construction loan happening during construction. That's because there's a loan drawdown on the land purchase. Secondly, there's construction drawdown costs over 5 stages or 6, wherever you are in Australia, and that requires drawdown payments as well. And then also at completion, there'll be repayments, P&I obviously, of the empty house as well. So I'm just looking at my feasibility here, Paul, and probably 25. There's probably a buffer you need of about 55,000 cash to maintain those payments to cover from construction timeframe of 10 to 12 months plus the empty period of 6 months as well. So again, do not assume talk to the investors here. Do not assume you got a tenant on day one and income coming in straight away. The average time frame or vacancy is about 5 to 6 months for the first tenant coming into a house. So you got to have that buffer. So Paul, do you notify clients about that, the cash component required for this little explanation I'm giving right now of drawdown payments, interest payments and vacancy period here?
So I give them a funds to complete, which tells them how much they need to settle the transaction, which is obviously important. They need to make sure they have enough money. I give them the P&I payments on what the loan is going to be when the house is finished. It is a bit difficult to tell them what the interest payments are going to be during construction because that loan gradually gets larger as time goes on. So initially they settle on a block of land. The loan might be only $30,000 at 7%. 2 months later, the builder puts down a claim for $120,000 for a slab. So then the loan goes to $150,000 at 7%. Another 35 days later, he puts in another claim. So as you can see, you don't exactly know the dates of these claims, but it will gradually increase to be that P&I payment at the end. And look, most of the P&I payments are around $5,000. So if you took the worst off scenario of 12 months at $5,000, there's your $60,000 that you're talking about.
Gotcha. Cool. Well, as long as clients are aware that this is the commitments beforehand, during and after, then that should be fine because, as you may agree with me, Paul, transparency is very important. People should know what they're getting themselves into, right?
Yes, most definitely. When they say buyer beware, do your homework, find out all the information, and then you can make the executive correct decision. That's what's best for you.
Exactly. Before we finish off, do you want to talk about LVRs for inside, outside super, established and under construction? Just a brief little summary there, please.
Right, so if you're doing an NDIS property for investment and or owner occupation, you can do it for that purpose. Minimum deposit is 10%. You cannot capitalise any fees above that 10%, so you can only borrow 90% inclusive of cost. Alternatively, slightly cheaper interest rate, slightly cheaper fees, clients will put in a 20% deposit. 80% deposit inclusive of costs. Unlikely to go for much larger deposits. It's probably not deemed necessary to spend all your money that way. Inside of super, so inside of a self-made super fund, you can do these deals as well for investment. Established property, 10% deposit, inclusive of costs. Construction loan, it must be 20% deposit due to obviously the length of time it takes to build. The lender's deemed it's a safer option to have a larger deposit.
Gotcha. So are you finding that the ratio between 90% LVR versus 80% LVR is equal or not?
It's pretty close. As I said earlier, some of the ones at 90% could have put in more. They just chose not to keep some money left in the kitty for a rainy day. But it's normally 50-50.
Okay.
The guys buying one property are probably putting in 20%. Those clients who are looking for multiple ones are probably going with the smaller deposits because they were saving some cash for future purchases.
Gotcha. And that LMI fee, is that tax deductible as well?
I'm not an accountant, Ming, but I would presume as a borrowing cost, it would certainly be something that I'd suggest they'd want to discuss with their accountant as all those charges would be.
Paul, I think we've pretty much covered the basics of lending for investors going into NDIS property. Any final words of advice for you to our listeners as to what to watch out for, what to prepare, to think about. Just, words of advice, basically.
Yes, and I suppose the thing I've learned over this process over the last few years, being that mine, I've been doing lending for 35 of them, and this was new to me 3 years ago, but I've pretty well got a good handle of it now. The lending side of it, I can quite easily help them with. I've learnt through going to conferences, etc., with NDIS properties and other SIL partners, etc., and listening to them speak, that the location is important. The type and design of the property that you build is important. You've got to think of it almost as, would I put my son or my daughter or my sister into this house? It's, those are key factors for getting tenancy. The nicer the house, the better the location, the more convenient to services that they require, the likelihood of tenancy is certainly going to be greater from my understanding.
Gotcha. Well, Paul, I do appreciate your time and your input today. I mean, having you in our office talking about things regarding these matters does help us understand more about the lending market out there. But more importantly, I mean, and I could say this, not necessarily you, I would never ask you to declare this, but talk to people like yourselves and other providers and other developers and builders. We can get a reasonable glimpse as to the volume, type of volume and amount of volume going out there around Australia in terms of SDA property in the NDIS space. And although you will never say it, Paul, and I will, because I actually have said it in the past on other podcasts, be very careful who you do business with, because there are things that we see that mum and dad investors cannot see, and there are things that people like Paul here can see with lending that we can't see in terms of the money being spent and what locations and how much volume. From our connections, we're able to deduce what is appropriate for investors, what to watch out for, and Paul, you're in a precarious situation, the fact that you can't say these things because you are merely a finance processing factory, so to speak. And it's not your place to make comment because you are in lending, not in property. So we, as a business ourselves, NDIS Property Australia, have the privilege to understand and see these this information from people like yourself, Paul, and other people in the same boat as you, to be able to give some little bit of guidance and buyer beware kind of approach to their approach moving forwards in this space. Because as we've said repeatedly, NDIS property is not for everyone. If you're a first-time investor, don't even bother going in. If you're a retiree with all your life savings there and about to jump into it, I would say don't do that. You got to be aware, educated, and confident that this investment you're doing in NDIS is for you. So the last thing neither us or Paul or anyone else will do is want to put someone who shouldn't be in NDIS property into NDIS property and then making a wrong decision and then ruining their financial lives. Correct, Paul?
Most definitely. I've had clients who have got houses under construction and said, Paul, will this be tenanted? Put my life into this. I've been told I'm going to gross a certain amount of money and will not have tenants. The only thing I can advise them is obviously keep talking to their referral partner, but go out and speak to SDA providers and SIL partners and tenanting agents and see who they have on waiting lists and what type of property that they're looking for. And if you can do that and say, look, I'm building one and it's in this location and do you want to have a look at it, and etc., you're helping yourself to ensure that when the times are right, there'll be a tenant ready to move in and hopefully more than one tenant.
Yes. Paul, thank you so much for your time. Appreciate it.
All good, Min. Nice to be here.
Bye-bye. Ta.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.